Hi all, this is Calvin here again. So welcome to this edition of Trade the Markets Like a Pro, a series of webinar videos. So for today, what are we going to share? All right, so for today's video, I'll be sharing with your risk management techniques. All right, so this is part one of the video. So in part one, I'll be sharing with you why do we need to have risk management, and also appreciate that if we don't cut our losses fast, it will actually lead to a trader's ruin. All right. So before we start this video, before I start sharing this video, let me take a look. Let's take a look at the disclaimer slides first. All right. So let me remove myself. Okay. All right. So in order to become a successful trader, this is the three trinity that we need to adopt or we need to have. All right. So the first one will be a proper mindset. This is called the psychology part. So this I will cover more in module 11. Followed by proper strategies, or I would say that strategies that are applicable to different condition of the market. So this that I've already covered much in greater detail from module 1 up to module 8. And module 9 to 10, that will be the risk management tactics. So yes, even though we have very good solid trading strategies that adapt to the kind of different trading condition or the different market condition, but if we don't apply proper risk management tactic to all this strategy, at the end of the day, we will still face losses. Okay, so what do I mean by losses and how do we actually have losses? It's actually due to these three deadly sins of trading. So if we apply these three deadly sins of trading, I'll guarantee you that you will be making losses in no time very easily. So the first one is will be averaging down on losses. That means at the end of the day, hoping that one big trade, we are able to cover back our initial losses. All right. But what if we don't cover back the losses and we keep on doing this? Our capital will get depleted very soon. And also over trading, which is the FOMO effect. That means the fear of missing out effect. This is actually very relevant to this social media age. Let's say, for example, if you start to see someone posting on Facebook, Twitter, or even on Instagram, or let's say from on TikTok, that there is a hot stock for us to buy, but because we already have a serial position in especially on the same cluster of stocks. Example of this, let's say for example, if we have long position on Apple, Tesla, and as well as Facebook. So all these are technology and growth stock. But however, right now you start to see someone posting on Instagram that there's a great buzz over Palantir Energy, which is also a growth stock that you want to actually obtain. So right now you have four growth stocks. But what if all these stocks starts to go down instead of going up? You make more losses, right? So this because that's over trading. And the next one, lastly, is trying to be hero and you're trying to fight a persistent trend. Let's say, for example, if you are looking to trade at the SPX 500, in the last 3 months, it has been going up. So you believe that this week it will go down. You believe so, okay? Without any proper trading plan. And you try to trade against the trend. But it may not go down, it may not continue to go up. Okay, because once a trend is being persistent over here, it doesn't pay well to fight the trend if you do not know how to quantify when this uptrend is being overstretched. Okay, so that actually I already covered in one of the module 8 is the counter trend trading strategy. So you can just take a look at that video for more details. All right. So in order for us to counter these three deadly sins of trading, instead to be successful, these are the three success factors we need to have to be a successful trader is to select trades set up based on the appropriate reward risk ratio. That's definitely depending on the win-loss rate. So that will cover more in part 2 of the risk management video. So ability to know what is the maximum loss per trade. So that will actually take into account of when how much you should trade. That means, i.e., the amount of position you should put in by knowing the maximum loss per trade, and also know when to take profits. All right. So let us go into before we jump into all this into greater detail. Let's take a look at the ideal world versus the real world of trading returns. So in the ideal world, right, let's say we have a constant stream of return compounded at 10%. So let's say our startup capital is $100, we get 10%, our capital grew to 110. The next period, we get another 10% return. our capital go to 121, and the next period we get another 10% return, our capital grew up to 133. So we have an average ideal world compounding return of average of 10%. This is the fantasy world that everyone hopes to be in as a trader. That means at the end of the day, every period our trading strategy grow constantly by 10% at the end of every period. So at the end of the day, if we maintain this kind of trading system, our capital will definitely go up exponentially, from 100 all the way up to 1,000 plus. Okay, but however, in the real world of return, there will be volatility. Okay, so as a trader, we cannot avoid volatility. So from if we have volatility, that means our return will not be constant at 10% at the end of every period. In some period, we may make more. In some period, we will lose more. So in the real world of trading, this is a kind of scenario. Let's say in the first period, we lose 10%. So from the starting capital of $100, our next period, end of period capital will be $90. It's much lesser. The next period, we didn't make anything. We break even of 0%. And over here, the next period, we make more of 48%. Okay, which and we end up to 133. All right. So at the end of the day, you realize that your real world compounding return on average based on this realistic path that we are taking is 12.67% if we average them together, but divided by 3, a simple average, 12.67. So some will ask, why is it more than 10%? Okay, because in order for us to have the end result of 133, we got to make more. Why? Because at the end of the day, because our initial volatility of is higher, that causes the return to be a loss. You see? So instead, we start with a 10% return, we lose 10% first before, in order for us to make back 133 at the end of the result. So we got to have a higher return at the last period to actually achieve that end targeted capital gain, a total capital gain of 133. Okay, that means the end capital. All right. So what I want to share with you over here is that we, as a trader, we got to embrace losses at some point in time in trading. That means we cannot have a trading strategy that always make a constant stream of return like 10%. Sometimes you will lose 10%, sometimes you will lose 2%, and sometimes hopefully it will make more than 10%. So at the end of the day, right, the first step we talk about return is there will be volatility. So to manage your volatility, we got to understand this table of losses. And the more losses we accumulate, our return got to be higher to cover back the losses. So what it means by this in this table, so let's start with 2%. So let's say, for example, if we have a 2% loss in our first trade, to cover back this 2% loss in our first trade, we need to make 2%. Okay, this is simple. But the interesting thing is that as our losses grow exponentially, 5%, 8%, 10%, you realize that the amount of return to cover back your initial losses grew exponentially as well. So example, if you lose 50% of your trading capital, it doesn't mean that you, okay, let's say for example, your trading capital is $100. Okay, if you lose 50% of it, that means you now have $50 left. It doesn't mean that at the end of the day, you need 50% to actually make back $100. No, you need to make $50. That means, i.e., you need to make 100% to actually return back to your initial capital of $100. Okay, so if you lose 70%, your return will be grew much more exponentially to 233%. So what it means that from this table, we can tell us that the more losses that we accumulate, and if we keep on over trading, if we average down our losses, for us to fight back, it will get tougher and tougher and tougher. So the only way that this can be successful in real world trading, that if you have unlimited capital to play, but we are not central bankers. We are actually a normal human being with limited capital. If we keep on accumulating our losses or averaging our losses, hoping that one particular big trade that we have will cover back the initial losses that we have, we are kind of living in a constant state of denial. Okay, that means at the end of the day, in the real world trading, we got to accept losses. Okay, this path, there will be this path of return instead. So in order to understand this path of return, we got to always minimize our loss at the start. That means we cannot allow our losses to start accumulating at the start of our trading. So what we're going to do over here is that we will need to adopt a anti-martingale system, which is preferred. So it's actually having a bet when there is a trade loss. So whenever there's a trade loss, instead of entering one lot, if you could enter, you enter half a lot. If there's a possibility, if your trading provider allows you to do so. And if you start to make a gain, we can actually double it up by two lots each time when there's a gain. So this is what I call a integral martingale system. That is when there is losses, you enter lesser. And when there's a gain, that means i.e. your trading system starts to be work according as planned to the trading condition. This is where we allow it to double each time when there's a gain. So all this will actually prevent us from a trader's ruin. Okay, what's a trader ruin is if we keep on accumulating losses like 50% and 70%, our return needs to be higher. That means we need to cross a higher hurdle. That means our trading system need to generate a much higher return in order for us to make back the earlier losses, 100% and 220 for a 70% loss. Okay, so with that, I've covered much part one of trading like a pro. So I hope that you have a better understanding of why risk management is very essential to be part of a successful trader. So thank you for your time, and I see you again in my next video for part two.